gave up managing billions to become a better investor. Episode 25. How were markets in July 2023 for you? Hello. Yes, it's time for another podcast. My goodness, it's been a busy last week. Lots of earnings numbers, central banks coming up with thoughts, geopolitical whatevers. There's been a lot going on, and a lot will continue to go on over the next week or two. But that's the corporate earnings season and much more for you. This is not holiday time. This is busy time, working time, etc. All good fun at many levels. It's kind of interesting, isn't it? We've just started August, but we've got to kind of think about how was July? How did that go? The first month of the second half of the year, I've already talked at length on a previous podcast about half one 2023 and my broader thoughts for how the second half of this year will go on. But what about July? How's that kicked off? It's kind of funny, isn't it? Because a lot of investors, particularly a certain type of investor, is always citing sell in May and go away and matters like that. And I kind of feel as if it sort of reflects some of the historic preferences for certain sporting activities or whatever at that time of summer period. My personal view has always been that the summer period's always been a very interesting time to be an investor, a time when there are generally a lot of opportunities, maybe less liquidity, but maybe that means there are more opportunities. Some strange reactions, sometimes overreactions to big events, some geopolitical, some just linked with companies, some just linked with the aforementioned lack of liquidity and related. All I do know is, and I think back to the early parts of my career, certainly my two most interesting periods as an institutional investor were during August. And so it's always had a certain attraction to me as a month to be an investor, just because of those historic opportunities that I took. But also I find now it's an interesting time to be an investor. Anyway, we'll see how August pans out. We'll talk more about that in the weeks and month or so to come. How about July though? How did that work out? Well, it worked out absolutely fine, actually. I mean, from an equity perspective, it generally was positively remunerative, i.e., portfolios, my portfolio, my pension fund portfolio and related made money, which is always a good start. Most equity markets were positive, not all, but most were up. That was in contrast to bond markets, which were much more mixed. And we'll come and talk about bonds and related in a second. But from an equity perspective, you obviously had, during the latter half of July, you had earnings season started to kick in. And I've talked about it in a couple of podcasts ago about some of my week one, week two of earnings season insights. And generally, if I had to super summarize it, it would be basically it's certainly still lots of uncertainty in markets, but lots of sort of good progress too. And this is what, let's face it, the capitalistic world does. It moves to find opportunity. And even though you've got to be careful always seeing whether companies beat or miss expectations, as I've said before, particularly in the US markets, too many expectations are lowered in order for them to be beaten when the actual earnings come out. Across, when I look at on a slightly broader range of stocks, particularly those in the pan-European markets, which don't have quite that sort of lowered expectations to beat sort of problem, I actually found a very workable earnings season. And that's a little bit because, as the IMF, not the IMF have some perfect indication or feel for how global economies are going to go, I did note the IMF did up a few targets for their 2023 hopes. And I think it does reflect a world where companies are saying, look, what we've seen over the last 6 months is lower costs, which is good. Okay demand, not perfect, but okay, workable. And certainly some of those concerns which maybe some investors entered this year with, or maybe they kind of developed as inflationary issues and central bank interest rate increases and whatever occurred over more recent months, which has kind of led to lots of kind of neutral positions in equities. We've got to be careful. Oh my goodness, I see technology is doing well, but let's just have a kind of a passive fund or something. That seems to be the smart thing to do. Kind of a view which I sort of had a different opinion to. I was feeling 2023 was clearly an active investing year, really right from the start. And that, to me, has kind of worked out well over the last 2-3 weeks of the corporate earnings season. It is an interesting world. As I said in previous podcasts, it does strike me that when I look across multiple different sectors, there are lots of opportunities there. But it's something where you need to learn what you're investing in, the reasons why. We're back to old school underlying active investment terms. So that feels like how July has been for me as an equity investor. And I think it's going to kind of be relevant as we move through August and beyond, to be brutally honest, across the rest of this year. Bonds, as I said earlier, haven't performed as well. As I talked about in previous podcasts, not particularly relevant per se for me in terms of my direct pension fund and related. I don't hold any bonds. And I've talked before about the reasons for that. I don't think I'm old enough, essentially. I think there are far too many things to be doing across my potential future investment life still in the equity and alternative market spaces. But for bondholders, it's been a more mixed month. We have seen rate rises, interest rate rises by various central banks, obviously most famously the Fed and the ECB during the second half of July, in reasons which kind of I'm struggling with a little. I do wonder whether in a few months' time they won't regret it. They'll never say that, but they may conclude that actually it wasn't perhaps fully justified or fully needed or fully required. I guess, as always, they'll take the view that it was required at the time, and now that as the months roll on, the data comes in, they'll take a different view. But I always, as I've said before on podcasts, I have observed over 30 odd years of looking at central bank policy and the like, that they do tend to make two mistakes during a cycle, one right at its start and one right at its end, in terms of when interest rates are no longer being increased and related. So we shall see on that front. What I do observe is very kind of akin to what many companies have said from an equity perspective, is that cost fears, inflationary angles and related are abating slowly. I mean, we had some news earlier today on the 1st of August from the UK talking about shopping costs and related. Some interesting updates from both the States and Germany at the end of last week. I'm almost a little bit surprised bond yields haven't gone, not overtly lower, but a little bit lower bond yields, higher bond prices. But I think people have got to get into their heads this notion, and something which certainly is a reason why I'm cautious about personally investing in bonds, is that I think the return you're going to get on a real basis is going to be perhaps not as exciting as people think. It's not that inflation is not going to hit that 2% level that central banks are so dying for. I think it's more the reality that inflation over the medium term is going to be running, let's say across the rest of the 2020s, at a 2 to 4% level, which will mean that bond yields, 10-year bond yields where they are today, are kind of only of moderate interest. I mean, yes, I know bonds have less volatility than equities on average, and unless we see something horrible with general government debt levels and related, bonds are going to be okay. They're going to be paid. They're going to give you a yield, and corporate bonds even more yield. And there's an attraction there. I get that, but I wonder whether it's going to be not actually in real terms as high as people think. We're going back again to multi-decade history here. Equity is ultimately giving you a more interesting total return. Now, you do need a backdrop, which is, of course, exciting, positive, and we've had large swathes of that over the last, I guess, 40, 50 years. However, I do wonder whether, even though there are issues and challenges out there, we'll talk about geopolitics and related in a second, but I know lots of people are thinking, oh my goodness, it's the 2020s or the 2030s are going to be the 1970s, 1960s, 1970s Mark II. But let's not forget that there are other different aspects in the world ongoing here. And I certainly think the changing, evolving profile of the global population, the aging of the population, the higher levels actually of wealth in the average person. I'm not just talking about a developed market here, I'm talking about developing markets. And hence how that changes sort of extreme outcomes such as wars and coups and matters we'll talk about in a couple of minutes. And I do wonder what that means in terms of the attraction of equities versus bonds. I think it's much more likely to occur. And to me, I'm still attracted by the the scope for particularly the developing world over the next, let's call it 20, 25 years. It reminds me still, too many developing markets today still remind me of growing up in the 1980s and 1990s in the UK, or for the average developed, what we would call now developed market economy. We shall see. All I guess I'm saying is that July again was a month where equities were more than workable. Bonds, I guess, were okay. No disaster, and from a total return investor perspective, you should have been invested somewhere. And even though I know we've seen people holding more cash, finding cash plus sort of options and related, I'm not convinced that from a particularly for pension fund, multi-decade potentially for many people assets, I think people should look elsewhere. That's still my view. And again, we'll come back to thoughts about pension fund structures and related. All I know is for the individual investor, the person who can choose their allocation, their broader asset class allocation, I think can actually do a lot better than the average corporate pension fund, even though you're obviously taking more risk by definition. We shall see. Brief word on commodities and related. We haven't seen any mega moves, some all right moves actually. Obviously some talk about slight loosening in Chinese policy, also actual loosenings in Chinese policy has aided commodity markets to a broad extent. And you've certainly seen across some of the commodity companies that have reported, I mentioned Rio Tinto, for example, in the previous podcast, some solid progress in their share price performances. And again, commodities, yes, it is a share, it is an equity, but it also has an alternative nature to it, a bit like looking at gold and related. You can invest directly in the asset or directly in a company which itself is producing the asset or accessing the asset at the commodity, etc. So my view is, though, that there are still opportunities for general investors in a range of alternative scenarios. Commodity facing and related areas are a particular favourite of mine, and looking forward in particular to some of the gold numbers coming out in next week, which I'll come and talk about on an upcoming podcast. I talk about geopolitics, and there clearly has been some noteworthy geopolitical moves over the last couple of weeks, not just updates from Russia and Ukraine and some sad issues and related there. Unfortunately, uncertainties there still continue, but in a way, I guess the most striking aspect is either centred on the weather or on matters in West Africa in terms of coups, and both events really, be it difficult weather conditions across places such as not just actually South Europe, but also parts of Asia as well. In terms of heat in some places, lots of rain in others, etc., indicate again that from a supply perspective, from a trade perspective, from a cost perspective, and I guess really I have to say from an inflation or potential inflation perspective, I'm actually more thoughtful about matters concerning weather and general supply matter, trade matters linked to weather and related supply issues than I am about what many would regard as mainstream geopolitical matters, wars, coups, uncertainties, and related. And I think, again, it comes back to the point I made a few minutes ago, which is that I think the world is changing. I know that it's easy to fall into we're just going to see the 1960s, 70s Mark II over the next decade or so, and concerns about rising power in some places and lessening power in other places, excess potential risk of nuclear weapons and related matters. But I have to say, if I had to be sort of from a broader macro perspective, I think that combination of the impact of aging populations stroke debt, which I've talked about before and will no doubt talk about again. I think what that means is that bond yields don't go as low as you think. Again, another reason for preferring equities. But also we come back to this notion of, well, what do potential or actual, I guess it depends on your view really, weather and related changes, what do they imply on a multi-decade perspective? And of course, that remains a correct and live and big and ongoing debate. All I would observe is that, again, I think equity choices, and again, it will be on future podcasts in terms of individual stock choices here, because I think that is still the best way to play it, rather than what many would have perceived as green investing per se. I think you can pick up that sub-asset class quite coherently through the choices of individual equities, albeit that you've got to also factor in, like you do with all other equities, the notion of what is good value and why, and related factors like that. And I think, unfortunately, I don't want to call that area ESG investing, because ESG is quite a broad church sometimes, but let's call it investors who want to embrace green and related matters. You've got to bring in a whole range of insights into that. Not uninteresting. It's all striking, and every single company I invest in correctly is talking about all these matters in a thorough manner. But in terms of what's already priced in, what's wholly priced in, what's overpriced into equities and what isn't, there's a range of other insights that need to be taken into that. We're coming back again ultimately to basic fund management and equity market appraisal matters, things that I've talked about in some of my own early podcasts in terms of the early years of my career and matters I learned over those periods, things which I guess I still draw on today, to be honest. As always, some of those early lessons are some of the best, and you just apply the updated version of them in more modern times, more today moments. Looking forward, actually, as an aside from the broader, what we would call geopolitical issues, we've got the BRICS meeting coming up in a couple of weeks' time in August. That'll be interesting, as well as seeing how El Nino matters do or don't come up. It's funny, I've got a couple of stories about El Nino, maybe in another podcast I'll talk about. What I would observe is that is probably more of a 2024 issue, I would guess. But as always, we shall see. All I do know is that, again, it brings you back to the world of commodities, albeit other areas of that sector, as again, I talked about, I think, in the last podcast with companies such as ADM and related, agriculture and related matters, and other key areas. Commodities are way more than just oil and gas, or even mining stocks, or gold, or related. You've got to get your head around agriculture and akin matters. So July has been interesting, useful, thoughtful, loads more results to come out during August. We've mentioned already the BRIC meeting coming up in mid-August. August is also an interesting month where, as I said earlier, it's one which historically I've always liked being an investor, an active investor in. I think there's scope for a bit of natural volatility. VIX index is low, very low on some measures last week, a multi-year low, even longer than that in some places, which is noteworthy. And certainly given that, even though everything, I think, in the corporate earnings season, not everything, but sufficiently, a sufficient number of stocks within the corporate earnings season have been good, on net, I've been positively surprised and positively found opportunities as well, even though all of that is good and very workable for the active investor. Scope for some extra excitement from a bit of short-term market volatility, of course, is always a potential outcome out there. After all, what is the on a day-by-day basis, what is it, 5% chance of markets going up and 49.5% chance of markets going down? It's something like that in any case, and you get the basic gist. You've always got to be, as a thoughtful active investor, aware that short-term movements of markets, and I guess short-term is way more than just a day, can be weeks and even months, can be driven by a variety of issues, be them practical and truly economic or macro, geopolitical, or just fear and greed and related matters. So lots of things to be excited about, lots of things to be thoughtful about. This week, of course, in a couple of days' time, as I talk, we've got the Bank of England with their update. As I mentioned earlier, the Fed and the European Central Bank, I kind of feel the Bank of England are probably going to raise rates. I definitely disagree with that, but got to respect the central bank thinkers at the Bank of England, clever people, they've got their ideas. I think, though, in hindsight, it may look not a wise choice to raise interest rates here, just like the last interest rate increase by the Bank of England may not look a particularly smart move by the time we get to, let's call it, the turn of this year, early 2024. We shall see. But nevertheless, I think lots of interesting changes there. I'm looking forward to thoughts from the Bank of England, how they're appraising and seeing the broader economic backdrop from their perspective and what that means for bond markets, interest rate profile, and the broader UK economy. So, as always, loads of things to be talking about. Loads of things to be excited about. It's good always being an investor. Not always easy, but sometimes it seems rarely to be easy. But that's the fun of the investment world, and certainly lots to be thinking about, lots to be talking about. So look forward to a podcast on Thursday after the Bank of England thoughts. I think it'd be good to have a quick chat through some of those matters, and then on Saturday I'll do another podcast talking about the corporate earnings insights this week, matters that I've seen from the different sectors in different country and different individual company perspectives. A few highlights from that. Lots of interesting stuff already, and loads more companies to come Wednesday, Thursday in particular this week. So all interesting stuff. Again, thanks very much for listening. I hope some of that was interesting. As always, contact me via email or Twitter or related to get in contact and have a few further conversations. But thanks for listening, and speak to you soon. Bye-bye.